Let's now relate the variance analysis that we have here to budgeting that we learned back in section A. We talked about the master budget, which is more a static budget at a particular level of activity. Now for variance analysis, we're going to convert that static budget into a flexible budget. And we'll do that by separating out the variable cost from the fixed costs. So talking about manufacturing costs, you got direct materials, direct labor and variable overheads. So these are the variable manufacturing costs which vary with the level of production. Fixed overheads, these are fixed manufacturing costs, remain fixed irrespective of the level of activity. So let's now go on the dashboard and build out my pro forma here. So we're looking at sales less variable costs, which gives us contribution, less fixed costs gives us profit. So ignoring the selling, general and administrative expenses, just looking at the manufacturing costs for now, we're going to have sales less the variable costs. Here we look at direct materials, direct labor, variable overheads. So that would give us contribution less the fixed cost. So only looking at manufacturing costs for now. So you got fixed overheads. That would give us the operating profit. Now let us first build out the static budget. So the budget that the entity Variety Manufacturing Company had developed at the beginning of the period, the static budget. And let's say these guys, they had budgeted that they're going to be selling 6,000 units during the period and the budgeted selling price per unit is $25. So the sales number, the budgeted sales number is 6,000 units into $25 each, $150,000. Now talking about direct materials. So look at this. They use 2 pounds of direct materials per finished unit. So assuming that they're going to produce and sell 6,000 units as per their static budget, they're going to use 12,000 units of the direct material. The standard cost for the direct material is $1.60 per pound. So they're going to use 12,000 pounds of direct materials at $1.60 per pound. So that will be $19,200 of direct materials. Talking about direct labor. Now the standard direct labor per finished unit is 3 hours. So to produce 6,000 units, they're going to use 6,000 into 3, 18,000 labor hours at $2.50 per labor hour. So the budgeted direct labor cost is $45,000. Okay, now the budgeted variable overhead per direct labor hour is $1.50. So to produce 6,000 units, they're going to use 18,000 labor hours, $1.50 of variable overhead per labor hour. So that is $27,000 of variable overhead. So we got the sales number less all the variable costs. That gives us contribution. So the budgeted contribution is $58,800. Fixed cost. So the budgeted fixed cost that they had was $8,000. So the budgeted fixed overhead is $8,000. So the budgeted operating profit, looking only at the manufacturing cost for now, was $50,800. This was the budget that they had at the beginning of the period, before the period started. Now, when we looked at the example, we saw that Variety Manufacturing Company, they produced, and let's assume this produced and they sold 5,000 units during the period. So the budget was 6,000 units. This was the budget, 6,000. Now, they didn't do 6,000, they only did 5,000. So let us put the actual results on my dashboard. So that was a static budget. Let me have the actual results here. So they did only 5,000 units. And let's assume that their selling price, the actual selling price per unit was $24. Look at this. The budget was that they're going to sell 6,000 units at $25 per unit. In reality, that didn't happen. They only did 5,000 units and they sold it for $24 per unit. So let's do the math here. $24 per unit into 5,000 units. That gives us $120,000 of sales in reality. So 150 that they had budgeted, but they did 120. Okay, now looking at their costs. So let's relate it to what we have done on my board here. So first looking at direct material costs. Now for 5,000 units, they had used 9,500 units or 9,500 pounds of direct materials. So since we are only looking at the production costs, let's actually clean this up a bit. So the standard for 5,000 units was 5,000 units of finished products was 10,000 pounds of direct materials at $1.60. But these guys, they only used 9,500 pounds. And these 9,500 pounds were bought for $1.65. So the actual costs for all the direct materials which was used in the production was 15,675. So we are assuming that they produced 5,000 units and they sold 5,000 units. So once again, the budget was to produce 6,000, sell out 6,000 units of finished product. In reality, let's say they produced 5,000 and they sold out 5,000 units. So I'm just avoiding the mess that would be created with inventory here. Okay, so now looking at this again. So the usage variance was $800 favorable here. The price variance 15,200 minus 15,675 is 475 unfavorable. Okay, we'll come back to variances again. So for now, let me get the numbers in place. So for direct materials, in reality, they had used 9,500 units, which they purchased for $1.65 each. So the direct materials cost on their income statement is $15,675. Okay, looking at direct labor. So in reality, they used 15,400 direct labor hours and the laborers were paid at $2.60 per hour. So that's total direct labor expense of $40,040. Let me put that here. 40,040. Looking at variable overheads, the actual variable overheads were $22,800. So let me have that number here. So the sales less all these variable manufacturing costs, that gives us contribution of $41,485. Now fixed costs, let's get back there. So the actual fixed costs were 8,100. Budget was 8,000, but they spent 8,100. Back here. So the fixed overheads, they were 8,100. So the operating income, considering only manufacturing costs here, we got 33,385. So far, so good. Now, let's only look at the costs. Let's look at the variable costs. Let me look at direct labors now. So the budget that the entity had for direct labor was $45,000. So in the static budget, they said that they're going to spend $45,000 in direct labor. How much did they spend? They spent only around $40,000, $40,040. So basically rounding it off, let's assume it's $40,000 here. We could say then they spent approximately $5,000 less on direct labor. They've done a great job. But wait a minute. The budget here said 6,000 units. So $45,000 of direct labor for 6,000 units. Did they do 6,000 units? No, they only did 5,000. So though it seems as if they've used less of direct labor, we also have to factor in that they did not produce what was budgeted. They produced, in this case, less than budgeted. Looking at the next one, variable overheads. Now, as per the static budget, they said that they're going to spend variable overheads of $27,000. In reality, they spent only $22,800. Just looking at these numbers, looks like they've done a fantastic job. Instead of spending $27,000, they spent $22,800. But the moment you look at the quantity of production, instead of 6,000, these guys, they did just 5,000. Naturally, if you do less production, you're going to have less of variable costs. So guys, as you understand, comparing the static budget to actuals is not like comparing apples to apples. And that is why we're going to add some flexibility on the static budget. What we'll do is we'll build out that flexible budget at actual level of production. So look at what I'm doing here. So I'm going to build out a flexible budget at actual production. So the actual production is 5,000 units. So once again, I have the static budget, the master budget at the beginning of the period out here. Actual results here. Now I'm building out a flexible budget at actual production. So in this example, we are assuming 5,000 units is produced and sold. The budget was 6,000 units to be produced and sold. Now let's look at it. So 5,000 units. So instead of doing 6,000, they did 5,000. The budgeted selling price per unit was $25. So 5,000 units at $25. Sales should have been 125,000. They look lesser than that, 120. I mean, that's because the selling price per unit was 24, not 25. They couldn't get the 25 from their customers. They only got 24. Okay, let's now look at direct materials. So to produce 5,000 units, as they did in reality, they were supposed to be using 10,000 pounds of their raw material. So that is exactly what we had here. So look at this. What we actually had done when we did variance analysis was we already had taken that flexible budget. So look at this. The actual 15,675, the actual that we have here. Now, the standard, the flexible budget for that actual level of production was 10,000 pounds of direct materials at $1.60 per pound. So that calculates to $16,000, which goes in on the flexible budget. So guys, understand, $16,000 is the amount of direct materials for 5,000 units of production. $19,200 of direct materials for 6,000 units of production. Okay, let's look at direct labor in here. So direct labor, the actual is $40,040 that we have here. Okay, the standard for 5,000 units of production. So they're using 3 hours per unit. So for 5,000 units, they're going to use 15,000 hours. The standard is $2.50. So the standard for these 5,000 units, the budgeted amount should be $37,500. Now, this would make a lot of sense to you. Think about it. The static budget said there is $45,000 of direct labors to be spent. But $45,000 should be spent when there are 6,000 units of production. So when we looked at the actual number of $40,040, we thought they did a great job. And that is why we started building out a flexible budget at the actual level of production. Now, we are not going to compare 40,040 with 45. We're going to compare 40,040 with 37,500. So for 5,000 units, they should have used $37,500 of direct labor. But they used $40,040. So instead of using $37,500, they used $40,040. So that means a direct labor variance of $2,540, of which $1,000 is due to efficiency, they were not efficient enough, and $1,540 is because they paid laborers in excess. Instead of paying $2.50 per hour, the HR guys, they paid $2.60 per hour. Okay, so that was about direct labor. Now let's look at variable overheads. So let's get to my board there. So for 5,000 units of production, they were supposed to be using 15,000 direct labor hours, and the standard for variable overhead is $1.50 per hour. So for 5,000 units of production, the standard variable overhead is $22,500. So let me put that number here. So now, as you can understand, I'm going to compare the actual variable overheads with the flexible budget number. So I'm going to compare 22,800 with 22,500, and I realized that they have spent $300 extra. So that is why we had 300 unfavorable here. Look at this. Efficiency was 600 unfavorable, spending was 300 favorable. Overall, 300 unfavorable. They've lost $300 here. So it didn't make sense comparing 22,800 to 27,000, but now it makes sense comparing these two numbers because the level of production is the same, 5,000 units. Static budget that had a different level of production, 6,000 units. So now on the flexible budget, the contribution calculates to $49,000. Now fixed overheads, as per budget, that's $8,000. Look at this. The fixed overhead number remains fixed irrespective of output being 5,000 or 6,000. That's why it's called fixed. So 49 less 8,000 gives us the operating profit as per the flexible budget should have been $41,000. So guys, now I'm sure you're able to understand and appreciate the concept of flexible budgeting. And the way we do that is by separating the variable cost from the fixed cost. So all these are all variable costs. This is fixed cost. So sales less variable cost gives us contribution, less fixed cost, operating profit. Now, let's first compare our actuals to the flexible budget. Looking at the costs first. So let me use my board and then get back to the dashboard. So looking at direct materials, the standard for direct materials, 5,000 units is $16,000. These guys, they only used $15,675. So that means they had a $325 of favorable direct material variance. Instead of using 16,000, they used 15,675. So 16 minus 15,675. Now this $325 can be split into $800 favorable usage variance quantity and $475 unfavorable price or dollar variance. So $800, this was favorable, so they've used it very efficiently. Instead of using 10,000 units, they only used 9,500 units. But they paid a little more. Instead of paying $1.60, the purchase guys, they paid $1.65 per pound of direct materials. So overall, because of this highly efficient usage, they were 325 favorable. So let me put that number here when we're comparing actual to flexible budget. So instead of using 16,000, they used 15,675. So this is comparing these two, we get 325 favorable. Okay, now getting to direct labor. Direct labor, the standard was 37,500. They used $40,040. We've broken it down into rate variance, the dollar variance, and quantity variance. In total, this is 37,500 minus 40,040. That's 2,540 unfavorable. So let me put that number in here. Let me get to variable overheads. Standard 22,500. actual 22,800. They lost $300 here, $300 unfavorable. So this could be broken down into a very efficient usage for variable overhead, $600 inefficient usage here, with a $300 favorable for spending variance. But overall, this is 300 unfavorable. So getting back there, looking at my variable overheads here, there is 300 unfavorable. Talking about fixed overheads. So fixed overheads, the budget was 8,000, they spent 8,100. Let's not look at this production volume variance for now, let's avoid it because we're going to look at sales volume variance. So let me just rub this part off for now. Let's just look at the spending part for fixed overheads. So this is $100 unfavorable. So let me put that there. Now comparing sales to sales, as per the flexible budget at 5,000 units, the sales number should have been $125,000, but it's just $120,000. So there is a $5,000 unfavorable here. Think about it, this $5,000 is unfavorable because instead of charging $25 per unit from the customers, they charged only $24. So for 5,000 units, $1 per unit unfavorable, $5,000 unfavorable. Because as you can understand, these numbers, these four numbers, these were for the costs. The top line here is the sales, the variance in sales, actual versus the flexible budget. So now when we total all the variances, we get this is $7,615 unfavorable. Think about it. Instead of having an operating profit of $41,000, they only had an operating profit of $33,385, which means $7,615 unfavorable. Okay, so that was when we compared actual versus flexible budget. And this column, these variances, we'll call them flexible budget variances. So guys, once again, when we compare actual to flexible, we get flexible budget variance. I think the name is easy to remember. We're looking at the flexible budget, so the variance with the flexible budget. All good. Now, let us look at the static budget variance. So let me if I compare the actual number here, $33,385, the operating profit, the actual operating profit, with the static budget, the master budget that we had, 50,800, I see that there is a variance of $17,415. So as per the static budget, we expected that the entity, they're going to have an operating profit of $50,800. But they did a bad job. They only had an operating profit of $33,385, $17,415 unfavorable. This is what we would say is the static budget variance. So when I compare actual with flexible, I get flexible budget variance. When I compare actual with static, I get static budget variance. Get this right. So static budget is the level of activity, the static level of activity that you had in your master budget. When you compare that with actuals, you get static budget variance. But this is not fair because you're comparing 6,000 units to 5,000 units, not apple to apple. That is why we did this flexible budget, where we had this flexible budget at the actual level of activity. Now when we compared flexible to actual, we got the flexible budget variance. Now the difference between the static budget and the flexible budget, these two columns, is due to the level of activity. Let's look at it. So in the static budget, we have 6,000 units. Flexible budget, we got 5,000 units. So that's 1,000 units lesser in the flexible budget. And that is why it is $25,000 unfavorable. Next, on the static budget, we got $19,200 for direct materials. On the flexible budget, we got $16,000. So that is $3,200 favorable. Think about it. If you produce less, you're going to spend less. So that's a favorable variance here. Same for direct labor. Instead of 45, it's 37,500. It's lesser because the production is lesser. So this is favorable 7,500. Variable overheads again. Production is lesser. You spend lesser on variable overheads. Static budget versus flexible budget. This is 4,500 favorable. Okay. Fixed costs. Now these are going to remain fixed, whether you do 6,000 units or 5,000 units. So this is going to be 0. So the total variance, total difference between the static budget and the flexible budget, this is $9,800 unfavorable. So guys, what I'm trying to say here is, we have a static budget variance of $17,415. This includes the flexible budget variance of 7615. So writing it, let me just draw an arrow here. So $17,415 of static budget variance includes the flexible budget variance of 7615 and the sales volume variance. So guys, understand, this column, the flexible budget variance, is because they were not able to maintain the budgeted amounts, even though we created this flexible budget at the actual level of production, and sales in this example. The sales volume variance, this is because of the difference between the static budget and the flexible budget, or rather the static budget, the difference in sales quantity. The sales volume was expected to be 6,000 units, but they did only 5,000 units. So even when we did the flexible budget at 5,000 units, we got the sales volume variance. So once again, what we are saying is the static budget variance is the sum of flexible budget variance and sales volume variance. Look at it. $17,415 is equal to 7615 plus 9,800. So 9,000, so this is 9,800 unfavorable. This is sales volume variance. This is 7615 unfavorable flexible budget variance. So I'm sure you're understanding this. When you're looking at static budget variance, this is actual versus static. So this is the entire amount of difference, static versus actual. When I'm looking at flexible budget, so this is actual versus flexible budget. When I look at the sales volume variance, this is flexible versus static. So once again, static budget variance is the difference between actual and static. All this difference, 33,385 and 50,800, which is $17,415. When you look at the flexible budget variance, this is one piece, which is actual versus flexible. When you look at the sales volume variance, that is flexible versus static. So guys, once again, static budget variance is equal to flexible budget variance plus sales volume variance. So we have here that an organization needs to have ways of getting feedback on the budgets they develop. In financial management, this means comparison of expected results as identified in the budget to actual outcomes, and this is known as a variance. The calculation and analysis of variances is essential to enabling an organization to achieve its objectives. On the second half of the page, we're looking at comparison of actual to planned results. So it says, in comparing actual to planned results, organizations look at the efficiency of the operations and its effectiveness in meeting organizational goals. On the sub-bullet there, underline efficiency. So efficiency focuses on how well the firm uses its resources. On the next sub-bullet, underline effectiveness, which focuses on whether or not the firm used its resources well enough to attain the goals of the firm. Now, to be both efficient and effective, an organization needs to examine substantive variances, the difference between actual and planned results. And this can be done by line comparison of actual to planned results or by an overall assessment of operating income variance. So we have here that an effective but inefficient operation is one that meets its primary goals even though it has cost overruns, versus an efficient but ineffective operation meets its cost objective but fails to meet its goals. Now, the process of investigating variations from plans and taking corrective action as needed is a key part of financial management control and planning. Where we're looking at the static budget variance of Variety Manufacturing Company. Now, doing a high-level variance analysis, we're going to compare the actual operating income to its budgeted operating income. So, this is based on the static budget. So, where you have actual operating income right there, actual for budgeted operating income, right, versus static budget. The variance that we would get is, right, static budget variance. So in this example, the actual operating income, that was $33,385 versus static budget, which budgeted an operating income of $50,800. So that results in a static budget variance of $17,415. Next, we're looking at a mid-level variance analysis, which is a more detailed analysis showing where the variances actually occurred. So you got a column for actual results, you got another column for static budget, and the last column, that's actual versus static, or in other words, right, static budget variance. Now, on the table here, let's try to identify the per unit revenues and costs as per the static budget. So on the static budget column, right, per unit. So the budgeted revenues were $150,000 for 6,000 units. That is, right, $25 per unit. Looking at variable costs. So direct materials cost was budgeted to be $19,200 for 6,000 units. That means, right, $3.20 per unit. Direct labor budgeted costs were $45,000 for 6,000 units. That is, right, $7.50 per unit. Variable overheads, they were projected or budgeted to be $27,000. That's for 6,000 units. Per unit, right, $4.50. So the total manufacturing variable costs, they were $3.20 for direct materials, $7.50 for direct labor, $4.50 for variable overheads. Totals to, right, $15.20 per unit. Looking at fixed costs, now fixed costs, they would remain fixed irrespective of the level of production. So that is why fixed cost, we don't need to calculate per unit. We know it's fixed at $8,000 in this example. where we're talking about the use of flexible budgets to analyze performance. It says flexible budgets allow for better control over variable costs. Now, if the firm decides to produce fewer units than called for in the static budget, the variable costs, they should go down in equal proportion with a drop in units. To the contrary, if the firm decides to produce more units than in the static budget, the variable costs, they should go up proportionally. So a flexible budget can be prepared either after actual results are known or before as a pro forma flexible budget. Next, we got the steps in preparing a flexible budget. So first is to prepare a static master budget. Determine the budgeted selling price, budgeted variable cost per unit, and budgeted fixed costs, and estimate output. So in this example, we have varieties highlight static budget is prepared at 6,000 units of sales. The next is to find the actual quantity of output, because this is the cost driver for the variable cost. Think about it. As actual output would increase, variable cost would increase. So the actual output, actual quantity is the cost driver for the variable cost. So in this example, the varieties highlight actual sales is 5,000 units. So that's basically 83.33% of the static budget of 6,000 units. Next step, you would calculate the flexible budget amount for total sales. So total sales would be equal to number of units sold, that's quantity, into budgeted selling price per unit. And on the previous page, we calculated that the budgeted selling price was highlight revenues at $25 per unit. So $25 per unit multiplied by actual sales of 5,000 units, that's $125,000 of revenues on this flexible budget. Then you would want to calculate the flexible budget amounts for expenses. So on the example that we've seen that the flexible budget highlight variable cost is $15.20 per unit. Highlight fixed costs, that's $8,000. Looking at the table that we have here, you got three budgets here. The middle one, the one with a shaded column, is right static budget. And using numbers from the static budget, we're going to build up highlight flexible budget and circle at 83.33%, because the static budget has budgeted sales of 6,000 units and we are building up a flexible budget with highlight 5,000 units of sales. So we're going to take sales right at $25. Variable expenses right at $15.20, and on the left right variable dollars. Then you get contribution margin less fixed expenses, which is right equal to $8,000, and on the left right fixed dollars. So now looking at the flexible budget at 5,000 units of sales. So 5,000 units multiplied by $25 per unit budgeted sales, that gives us $125,000. Variable expenses, so that'll be $15.20 multiplied by 5,000 units, $76,000. Fixed costs, they remain fixed at $8,000. And this gets us to operating income of $41,000, which is right 32.8% of sales. Versus on a static budget, we had operating income of $50,800 on sales of $150,000, which is right 33.9% of sales. Now, because the flexible budget is flexible, you could create it at any level of output, any level of sales. So we have created another budget, a flexible budget at 110%, where the sales is 6,600 units. It's more than the static budget, 6,000 units. So again, you would calculate sales at $25 per unit. So 6,600 units into $25. So that gave us $165,000. Variable expenses, again, they are per unit. So $15.20 multiplied by 6,600 units gives us $100,320 variable costs. You get contribution of $64,380. Fixed expenses, they're going to remain fixed at $8,000. So this calculates to an operating income of $56,680. That is right, 34.4% of sales. So as you can also realize, the operating income percentage on sales increases as there is increased sales, because fixed cost, they are remaining fixed irrespective of the level of sales. Even though you're increasing sales, they remain fixed, which increases your profit percentage. Where we have highlight static budget variance. We know that's right, actual versus static. Now the static budget variance is equal to highlight flexible budget variance, which is right, actual versus flexible. Circle the plus sign and highlight sales volume variance. Now sales volume variance, that's right, flexible versus static. So once again, static budget variance, that's equal to flexible budget variance plus sales volume variance. Now let's look at the static budget variance analysis for variety manufacturing. And we got a table here with a lot of columns. The first column with the dollar numbers, you got actual results. Now we'll start with comparing actual results with the flexible budget. And we are looking at the flexible budget right at actual output. So actual results, the number of units sold is 5,000 units. And we are looking at the flexible budget with the same 5,000 units. So put a box around the 5,000 units under both these columns. So actual results versus flexible budget, that gives us highlight flexible budget variance. Then we're going to look at the static budget, and we know that the flexible budget versus static budget, that would give us highlight sales volume variances. Now we got flexible budget variance and sales volume variance. We know that flexible budget variance, put a plus sign above the sales volume variance column. That would give us, put an equal to sign above the last column, which is highlight static budget variance. So once again, static budget variance, that's equal to flexible budget variance plus sales volume variance. Now looking at the dollar numbers, we have flexible budget variance of highlight $7,615 unfavorable. We got sales volume variance of highlight $9,800 unfavorable. Now we're going to add both these together. So put a plus sign before $9,800, and that gives us right equal to and highlight $17,415 unfavorable static budget variance. So as you can see, flexible budget variance plus sales volume variance, in total they are static budget variance. Let's look at the text where we're trying to interpret variances. So it says flexible budget variance shows the effects of differences due to actual selling price, variable expenses and fixed expenses. On our example, this is right $7,615 unfavorable. So highlight unfavorable flexible budget variance, that indicates that underlying input costs were higher than budgeted. You spent more than what you budgeted. Right there. And slash or sales price within brackets dollars, they were less than budgeted, and underline sales price. On the next sub bullet, you got sales volume variance. Now that shows the effect of the difference in actual quantity output from budgeted amounts. So that is right, $9,800 unfavorable on our example. So highlight unfavorable sales volume variance. That means that underline the market is smaller than estimated. Draw an arrow and write sales volume within brackets quantity, they were less than budgeted, and underline sales volume. On the left hand side, put a bracket around the flexible budget variance and the sales volume variance. And right there, static budget variance, that's equal to $17,415 unfavorable. So the static budget variance, it includes the flexible budget variance and the sales volume variance. Flexible budget variance, it includes the variances in the sales price or sales dollar as well as variances in input costs. The sales volume variance, as the name signifies, includes variances in sales volume or sales quantity. We get the concept for management by exception. So it says, by more closely analyzing variances, a business is better able to make decisions based on these variances. Put a box around management by exception. Now, it focuses attention on highlight significant variances from the budget, both favorable and unfavorable. We are looking at the analysis for flexible budget variance. Now we know that, right, static budget variance, that's equal to flexible budget variance plus sales volume variance. Now put a box around flexible budget variance and draw an arrow downwards because that's our focus in this section. Now flexible budget variances, they include the price or dollar variances for direct materials, direct labor, variable and fixed overheads, as well as efficiency, that's quantity or usage variances for direct materials, direct labor and variable overheads. So all these are, right, cost variances. So these are flexible budget cost variances. Now on the right hand side, I wanted to write a note down here. Right, flexible budget variance, that's equal to sale dollar variance plus direct material, that's DM, direct labor, DL, overhead, OH. So all these dollar and quantity variances. Next, right, sales volume variance, that's equal to sales quantity variance. And draw a bracket on the left of that, right, static budget variance. On the second half of this page, we got a table with a breakdown of variances for direct material, direct labor, variable overheads and fixed overheads. Under direct material variances, we got variances for price or dollars and usage or quantity. Now, direct material price variance, we had seen that it was, right, $505 unfavorable. Now scratch it out and write $475 unfavorable because only $475 of the direct material price variance went into the income statement. So we had seen that the direct material purchases were in excess of those used for production because that goes onto the balance sheet. On the income statement, you have only direct materials as part of cost of goods sold, and In our example, this is $475 unfavorable. Direct material usage variance, that's right, $800 favorable. Now, talking about direct labor variances, you got variances for rate or dollars and efficiency or quantity. Direct labor rate variance is right, $1,540 unfavorable. Direct labor efficiency variance is right, $1,000 unfavorable. Next, you got variable overheads. So that includes variable overhead spending or dollar variance and variable overhead efficiency or quantity variance. So the variable overhead spending variance is right, $300 favorable. Variable overhead efficiency variance is right, $600 unfavorable. And finally, you got fixed overheads. So the fixed overhead spending variance is right, $100 favorable. Now on the right hand side, put a bracket around all these variances that we've just seen and write include $2,615 unfavorable. So all these cost variances, so in total that's $2,615 unfavorable. Now that's included right in flexible budget variance. So once again, flexible budget variance, that's going to include variances for direct material, direct labor, variable overheads and the fixed overhead spending variance. And on the last row of the table where you have fixed overhead production volume variance, right, for static budget variance calculations, sales volume variance is considered, and put sales within quotes, right, not production volume variance, and here put production within quotes. So as we know, static budget variance, that's equal to the flexible budget variance plus the sales volume variance. Since we're looking at the variance in the income statement, we do not need to consider the production volume variance that we had calculated when we had done fixed overhead variances. On top of this page, right, static budget variance, that's equal to flexible budget variance plus sales volume variance. Put a box around sales volume variance and draw an arrow downwards, because in this section we are focusing on a variance analysis for sales volumes. Now looking at the chart where we're trying to understand the sales volume variance, we are comparing highlight actual operating income to highlight flexible budget operating income to highlight static budget operating income. So we know actual versus flexible, that is circle flexible budget variance. We also know that actual versus static, that is circle static budget variance. Now, when we compare flexible budget versus static budget, that is where we get highlight sales volume variance.